Good evening, everyone, and welcome to the Arlington Heights Memorial Library online. My name is Barb, and my co-host tonight is my colleague, Mary Kay. Our program tonight is Making the Most of Social Security, and our presenter is Mike Heatwole from the Dala Group. And I just wanted to tell you that we have a couple of upcoming programs where we're running a series called Meet the Makers. And these programs are interviews with makers from Chicago and the surrounding area. They discuss being a maker, they demonstrate their work, and they answer questions. And two of the programs that are left in the series, one is December 11th with Lori Freivogel and December 15th with William Estrada. And you can learn more on our website at www.ahml.info/makers. And as always, we have a lot of great programs for all ages coming up, so visit our online calendar. I will put the link in our chat. So thank you everyone for coming, and I will now turn it over to Mike.
All right, thank you, Barb. I appreciate it. So let me just share my screen here for the PowerPoint presentation that we'll be going through, and then we will go ahead and jump in. So tonight we're going to be talking about Social Security. We have a lot to cover. And we're going to be covering everything from the basics of Social Security to make sure that we're on the same page. We're going to go through the benefit statements and a couple of items that you want to make sure you look at when you're reviewing your benefit statement. And then we'll move on to the filing strategies for single, married, divorced, and survivor benefits. So we're going to try and cover the whole, gamut there. And then we've got, if you are a TRS or government employee and you have a pension that may offset your Social Security benefits, we'll talk about that as well. The last couple of items we'll be talking about are the earnings limits for Social Security. So how much can you earn and still collect the Social Security benefits? And then how is Social Security benefits taxed by both federal and state? So again, we have a lot that we're going to be covering tonight. Typically the program runs to about 8:15 or so, depending on how many questions we have. Again, as Barb had mentioned, if you have questions, make sure you put those in the chat. I will stop every 5 to 10 minutes as it makes sense, after each section to see what questions we had for that section, and then I will keep the presentation moving from there. So, all right. Just a quick disclosure, all of the information we're covering tonight is supposed to be general in nature. So I am not giving you advice on your specific Social Security benefit strategy or your financial plan. You want to make sure that you are consulting with your financial planner, your accountant, your attorneys as you make these decisions. Just a little bit about my family. I want to introduce you to them. So my wife, Linnea, and I have been married for 13 years. We were married in 2007, and we've been together for 19 at this point, high school sweethearts. My kids are Elin and Audrey. So my daughter, Elin, is 4.5. So she's the big one there, and she is working on reading right now. So she's learning all of her letters and numbers. And she just did a map of the world. So she was very excited about that. So that's kind of what's going on in her realm of the world. Audrey is now fully crawling. And she is also pulling herself up onto the furniture and standing on her own 2 feet. She can't walk yet, but we're pretty close, it seems like. So she's also eating solid foods now. So that's her highlights of her life at the moment. And then down in the bottom left is a picture of myself, my wife, Linnea, and her father, Lester. And the reason we put this picture up there is that it has, that background has a lot to do with why I'm a financial planner and why I focus mostly on retirees. And so in high school, Linnea and I met. I was a senior in high school. She was a junior. And at that time, she lived with her father. She was the only child in the house. Her sisters were much older, and her mom had died earlier of breast cancer. And so at the time that I met her, her dad had had a stroke 4 years prior to that date when I had met them. And so he was in a cognitive decline where that stroke just continually kind of declined his ability to be able to function and to be able to make decisions on his own. And so by the time that I met them, Linnea had mentioned that, there were bills stacking up on the table and she wanted help looking through everything to figure out what was going on. And so what we had found is that in those 4 years from the time that he had a stroke to the time that I had met her, he had gone from 750,000 for retirement down to 40,000. And so he had basically nothing left from what he had earned in his working years. And so a lot of that was given away to family and friends and charities when he really shouldn't have been giving that money away. He needed it for his own care. So it put us in a tough position. And so going into college, Linnea and I decided we were going to live with him for those 4 years, be his caregiver as much as possible. And so we were able to caregive for him through that full 4 years of college before it really just became too much for us. He needed 24/7 care. We were getting calls from the fire department about him falling too often and needing help to get up. And so they were going to start charging us for those visits. So there's just a lot that happened there. So that backstory is why I focus on retirees. We can't always prevent these things from happening. We can't prevent necessarily a stroke from happening, but we want to make sure that we have the plans in place to understand whose responsibility it is of the other family members to help with both medical and financial care. And then also what the wishes of, you as an individual are prior to anything happening so that we can have those spelled out for the family. So again, just a little bit about me and the backstory as to why I got into financial planning. I am a financial planner in Hoffman Estates, and I am a certified financial planner, and my practice is about 150 households that I serve now. So, all right, enough about me. Let's move into Social Security because I know that's why you're here. So with Social Security, the one thing that I put up here before we get into any of the other pieces of Social Security is, what is the outlook? And the reason that I have that first is because if you're sitting here listening to this webinar and you don't believe that Social Security will be around in your retirement, then the rest of the presentation is completely worthless to you. Because if I'm helping you maximize your benefits and I'm helping you understand what your different filing options are and how it's going to be taxed, well, if there is going to be no Social Security, then the rest of that is worthless. So at this point, one of the things that we do know about Social Security and the current position, financial position of the program, is that on your benefit statement, it tells us that by 2035, so 15, let's call it 14 years from now, we are looking at having the Social Security Trust Fund fully depleted. And what that means is that by 2035, we need the benefits that are being paid out to Social Security participants to be equal to the Social Security taxes that are coming in from payroll taxes. And in order to do that, Social Security right now is estimating a 20% benefit cut when we get to 2035 on all Social Security benefit individuals. So what that means to you is that we do have a possibility where halfway through your retirement, so 15 years from now, 14 years from now, you could see some sort of benefit cut. Now, we don't know what that number is going to be. It's too far away to get an accurate prediction of that. A lot can change in the next 15 years. What I can tell you, one silver lining is that I've been doing these presentations for 8 years now. And when I started these, those estimates were that the trust fund would be depleted by 2031. So it was 4 years earlier. And that the benefit reduction was going to be 27% instead of, what it's now being estimated at as 20. So again, the benefit reduction is coming down. So it's going in the right direction. And when the trust fund is fully depleted, is getting moved further down the road, which is a good sign as well. So hopefully that continues, or we at least get that 20% number down further before we get there. So that's just a little bit about the Social Security outlook and where we're at right now with the program. All right, this is just a quick graphic to show you why we're having an issue, one of the reasons we're having an issue with the program. And so right now, back in 1950, when the program was put in place, you had 16 and a half workers for every one person who is collecting Social Security retirement benefits. That number is now 2.8 workers for every one who is retired and collecting benefits. And by 2035, that's estimated to be 2.3, I believe. Sorry, my little Zoom thing is in the way here. Yes, 2.3 in 2035. So that just gives you a little estimate as to why the program is having financial issues. We had many, many more workers paying in for every one collecting versus now. And we also have divorce benefits, which I'm going to talk about later, that further pulls that down. So In any case, that's where the system is now. So I'm going to talk about the basics of Social Security, and then I'm going to stop for questions. So again, as a reminder, if you have questions as I go through this portion, please submit those through the chat, and then I can read those out loud and provide answers. So there are 4 different ways that you can qualify for Social Security retirement benefits. The first bullet point is the one that we're going to cover the most here. And then the last 3 bullet points I'm going to cover later in the presentation. So I only give a brief overview of those. So you can qualify as a worker. So that means that you paid into the Social Security system. You can also qualify as the spouse of someone who paid into the Social Security system. You can qualify as the ex-spouse as long as you were married for at least 10 years, or as a surviving spouse if you were married when that individual passed away. So again, I'm going to cover the last 3 later. And so I'll get into the details and the rules around those and how that works. But let's talk about the first bullet point here first. So a worker who has accumulated a minimum of 40 work credits is now qualified for Social Security retirement benefits. So we need to understand how you get those 40 work credits. In today's dollars, so in 2020, the dollar amount to earn 1 credit is $1,410 of earned income for the year. So if you earn 4 times that, let's call it $5,600 in 2020, you would earn your full 4 credits for this year. Now, what that means is once you qualify, so you have those 40 work credits, again, that's any time during your lifetime. So it can be 10 years of working at any point during your lifetime. It does not have to be consecutive. So once you have those work credits, now you are qualified for Social Security retirement benefits. But now we have to figure out how that's calculated. How is your benefit actually calculated? And that's done by taking the top 35 years of earnings during your career. So there's kind of really 2 different scenarios. We could take an individual who has, let's call it 40 years of earnings during their lifetime. And so for that individual, the bottom 5 years is not included when they do the calculation for your Social Security benefit. Okay, so it's just the top 35. And what that means is that for every year you are working now and making more than you did in the bottom of those 35 years, then the annual amount now replaces that bottom 35th year. And so every year that happens, they recalculate that Social Security retirement benefit for you, and it increases slightly each year as you continue to knock off those lower numbers. Now, what's not understood is that you can actually do that even after you have filed for Social Security benefits. So once you have filed for Social Security benefits, if you are still working full time and making more than you did in the first of those 35 years, your benefit will continue to be recalculated each year and continue to grow for you. So that's just, it's just something to keep in mind. Now you have the second scenario. So I talked about the person who has 40 years of work experience. What about someone who has 20 years of paying into the Social Security system? So for that individual, you have 20 years of earnings that will be included when they do the calculation. And then you've got 15 years of zeros. They do include those zeros in the equation. So for every year that this individual works now, it will replace one of those zeros as they continue to work. And so that helps them exponentially because every time a 0 gets replaced with a number, that drives that benefit up. So just something to keep in mind in terms of how those benefits are calculated. Now, again, the other 3 I'm gonna talk about later on here. So I'm gonna stop there to look at, I saw a couple of questions may have come in. So give me a second here. Let me just look.
Mike, while you're reading that question, I just wanted to make sure that everyone realizes that we're recording tonight. And since your face and your voice is not on tonight's program, I hope that is okay with everyone. I should have announced that at the beginning, but everyone knows now.
Yep. Okay. Sounds good. And then I did have one question come in. So it says, has COVID made the potential SSA reduction and date worse? Either people not working or not at same income, so FICA contribution is less. So logically, my response would be yes, it likely has made this worse. On top of that, Trump also passed the Social Security tax cuts for these last couple of months where employers could, not send in their Social Security taxes for up to 3 months. But it looks like that's really was just a delay and that's still going to be paid in. So that doesn't have too much of an effect unless that's kept in place, where they're delaying or just eliminating those taxes altogether. So, short answer is yes, it probably has made it worse. We don't know. We've been given no estimates from Social Security Administration in terms of what that looks like now. So, and I think that's the only one we have at the moment. All right, so I'm going to keep going. And oops, sorry about that. All right, so let's talk about your Social Security benefit statement. So with your Social Security benefit statement, there's a couple of ways that you can get it. The first one is the easiest, which is that it's being mailed to you. So for some of you, it's being mailed to you, and for others, it's not. I don't know their logic in terms of who they've decided to mail it out to and who they haven't. My understanding was that it was supposed to be based on certain ages. So like when you hit 50, 55, and 60, you were going to get a statement in those years, those calendar years. And then I thought that once you got past 60, my understanding was that they would send it out every year. That doesn't seem to be happening because, when I was doing these in person, I used to have people raise their hand, who's received it in the mail, who hasn't, and it was normally about 50% of the room. So if you have not received a mailed copy of your Social Security benefit statement recently, there's two things you can do. One, you can call up Social Security and ask them to mail one to you. And then the second way is that you can go on ssa.gov, which I believe is much quicker than sitting on the phone with them. So if you go to ssa.gov, you can click on the sign in up button that's up on the top right-hand corner. And then you'll scroll down a little bit. And on the left side, there's a My Social Security button. When you click on that, it's going to ask you to register if you've never been there before. And so you'll want to put in your personal information. It'll ask you some security questions from your credit file. And I just always provide a quick warning here or a few tips. I have a lot of clients that get themselves locked out of the Social Security system, even though they are the person who, is supposed to know the answers to those security questions. And it's not necessarily their fault that, sometimes these questions are very tricky. So they'll ask things like, which of these banks did you refinance your primary mortgage with back in 2015? And, there'll be a list of 5 banks, and they may have the bank that you refinanced with, like who did the original refinance. And then they have the bank who holds your mortgage now because it's been sold since then. So if they ask for who is the bank that you refinanced with, they want to know the original bank, not who holds it now. So you need to be careful about read the question, make sure that you understand what they're asking, and then select your answer. And then the other thing that they like to do is they like to throw questions on there that have nothing to do with you. So in my experience, it's been about 50% of the questions are not applicable to you. So don't be afraid to answer the choice that's always there of, this doesn't look familiar or it doesn't apply to me. So again, those are just a few tips to get in. Once you are into the system, you will see your benefit statement. It says view print statement. So you can view it as a PDF or you can print it, so that you have a hard copy. And so it's a 4-page document. So most of us have seen our statement. The first page doesn't have much information on it, so we're going to skip past that. The second and the third page is what I want to point your attention to because there's a couple of items that we need to make sure that we're reviewing as we get closer to retirement. So on page 2, this is page 2 that we're looking at of your benefit statement. This is the top half of that page. I've cut off the bottom half because it's just text. Okay, so I wanted to look at our actual benefit estimates and walk you through that. So every time that you're looking at your benefit estimates, you're going to see 3 benefit estimates. So you're going to see your full retirement age estimate, which is the top one. You'll see your age 70 estimate, which is the middle one, and then your age 62 estimate, which is the bottom one. Okay, that's those first 3 lines that are on the page here. Now, keep in mind, if you're past 62, let's say you're 64 this year, it'll show that bottom line. Instead of it being at 62, it'll show it to you as if you took it today, so at 64. So that's the only difference that you may see on yours. And then your full retirement age will be based on your year of birth. So here I have 66 years and 8 months listed as the full retirement age. Yours might be slightly different depending on what year you were born. So the top number, the estimate that's there, the 1851 in this case, is calculated off of those top 35 years of earnings like I talked about before. Now, what's interesting about this page is that the other 2 benefits are now then calculated based off of the 1851. Okay, so the top one is your top 35 years of earnings that they do a calculation and come up with the benefit estimate. And then the other 2 are based off of the 1851. So anytime the 1851 changes in future years, due to different earnings or, more earnings now versus, before. Anytime that number is changing, your age 70 and your age 62 benefits will change as well. Okay, so just keep that in mind. All right, so now that we've got that out of the way, let's talk about age 70 and 62 benefits. So the age 70 benefit, all that's doing is taking the 1851 and it's giving you an 8% increase per year for every year that you are waiting from full retirement age to age 70. So in this individual's case, because their full retirement age is 66 years and 8 months, if they wait until 70, that means they've waited 3 years and 4 months to collect. Okay. Age 70 is the longest you would want to wait. It does not grow past age 70. So don't wait past age 70 to take your benefit. So, okay, so we get to age 70. And so what we get is 8% per year. So if I'm 3 years, so that's 24%, right? So 8, 16, 24. So we're at 24%, plus I get another 4 months worth of credit. So let's just call that 3% just to keep the numbers easy here. So it's a 27% increase. So that's where the 2344 comes from, is it's a 27% increase from the 1851, okay? Now, the 1314, so the age 62 benefit, is a reduced benefit because you're now taking it early. And again, it depends on what your full retirement age is as to how much of a reduction you receive. So in this individual's case, if they take it at 62, they are taking it 4 years and 8 months early. And so I wish it was as simple as just saying, well, it's 8% per year before retirement as well, but it's not. It's closer to 6%. It's between 5 to 6, depending on your full retirement age. So let's just call it 6% is the per year reduction. So if I take it 4 years and 8 months early, I'm looking at a 24% plus another, let's call it another 3%. So again, we're right in that 27 to 28% reduction for taking it early. Okay. And that's where the 1314 comes from. So anytime you take it early, it will be reduced. And every month that you get closer to full retirement age, that reduction shrinks, as does every month that you wait past full retirement age, you get credit for that waiting. So for every month past full retirement age going to age 70, you get 8 divided by 12%, which is 0.67. Every single month, you get 0.67 increased on that full retirement age benefit. So hopefully that made sense in terms of the 3 different benefits that are there. But here's the most important piece. So pay attention to this part, is that those benefits are estimates. That's why it says your estimated benefits. And those estimates are based off of an assumption that Social Security is making, which may or may not be correct. So we need to always pay attention to this assumption. That is found down at the bottom of this page. It's the second to the bottom line, where it says your estimated taxable income in 2020 is $46,770. Okay. So for this individual, what Social Security is assuming is that the individual will make $46,770 from now until full retirement age. And the reason they came up with that number is that was the last reported earned income of this individual. So if we were looking in 2020, you would see whatever you made in 2019 and paid into Social Security, that's what would be the number that's showing up there in their assumption. So the reason that's important is that if you are planning on retiring, let's say at 60, but you're not going to take your Social Security benefits until your full retirement age, then you're actually going to have, in this case, 6 years and 8 months where you have no income from 60 to 66 and 8 months. And they were assuming that you would be making 46,770 to come up with your benefit estimates. So because of that, your benefit estimates will actually, like your actual benefit that you receive, will likely be less than what is being shown on your current benefit statement. So if you want to get a more accurate picture as to what your true benefit is going to be from Social Security at full retirement age, you can use the online calculator, which is at ssa.gov, and they have an online retirement calculator where you can plug in your earnings. And then you can tell the calculator, you're not planning on working past 2021 or 2022. And it'll recalculate those benefits for you based on that new information. So just keep that in mind in terms of the assumption that they're making there, and make sure that that actually is a true assumption for you. And if not, definitely use that calculator to get a better benefit estimate. Now, I don't talk about disability much in this presentation. That could be its own like 2-hour presentation. So if you are in Social Security disability or are looking to apply for that, please definitely seek some help from either a planner who's experienced in that or an attorney who's experienced in that. The system is very complex. There's a lot of moving parts to make sure that you get approved and that your other benefits are lining up with the Social Security disability. So you want to definitely make sure that you're getting help as you go through that process. So, but just as a precursor to that, there is a disability benefit shown on your estimated benefits, which gives you an idea in terms of how much you would collect if you were approved for Social Security disability. And that's the 1826 number that's shown there. The survivor benefits we're going to talk about later, so I'm not going to touch on those here. And then I'm going to cover this slide and then I'll go to the chat to look at questions here. So page 3 now of your benefit statement is your earnings record. So if you've looked at your benefit statement, you know that this shows your earnings record all the way back into the 70s, 80s, 90s, 2000s, through your whole career. It's showing your earnings, for each and every year. I've blown it up here so that we can see it. The numbers are easier to see. You can see that what I'm looking for when you are reviewing your earnings records is any big errors that are easy to find. So what I mean by that is in this case, you see zeros in 2011. So if you were an individual and you know that you never took a year off, you were working from 2010 to 2020, but you have zeros listed on 2011, we know that we need to get that corrected with the Social Security Administration. And so I tell all my clients, every 2 to 3 years, make sure you're logging in and looking at your benefit statement to make sure that they are reporting your income. Okay, because I've had this happen in the 8 years. It doesn't happen much, but in the 8 years that I've been doing this with these presentations, there's been 2 individuals who had those zeros where it was never reported to Social Security, and so they had to try and get that corrected with Social Security. The quicker you catch it, the easier it is to get corrected. If the error is in 1990, it's going to be very difficult to come up with a tax return for 1990 to provide to Social Security to get that corrected. So, and again, why does that matter? Why does it matter if there's zero there? It matters because your benefits are based off of those top 35 years of earnings. And so we want to make sure that any earnings that you've paid into Social Security are being counted, not having a zero there. So, all right, so let's tackle the chat box here. Let me take a look at what we've got going on. Okay, so what's the maximum amount for the 3 stages of benefits? So I'm assuming by 3 stages, you mean like the full retirement age 70 and 62. So I'll answer this I've got the maximum for the full retirement age benefit, which is the one that matters because then the others can be calculated off of that. Because again, that's the only one that they use for the calculation. So let me just see, in 2020, the maximum Social Security benefit for an individual at full retirement age was $3,000 or $3,011 per month. That was the maximum per month at full retirement age. So if you waited until 70, for instance, that 3,000 can grow now to, let's call it 4,000 a month. And so that would be the maximum. The maximum is always going to be based off of that $3,011 for full retirement age. Now we have a question. Does the Social Security statement take into account the future expected benefit reduction in 2035? Looks like no. So you are correct. The answer is no. Does unemployment insurance count as income for Social Security? That is a good question. I don't believe it does because you're not paying FICA tax on that unemployment insurance. I don't believe you're paying Social Security and Medicare insurance on that unemployment benefit. So I would have to do a quick check on that to make sure, but I'm almost positive that's the answer, is that it does not count towards income for Social Security because you're not paying those Social Security payroll taxes on that income. So hopefully that helps. It looks like that's all the questions we have at the moment. All right. So with Social Security strategies, here's what we're going to do. We're going to start with a single individual. And I put this very simple graph up here just to give us a quick overview of what a cost benefit analysis looks like, where we're trying to figure out, what is a break even for, the different options I have for taking a benefit. And so here's what I mean by this. If you are married or divorced, where we have survivor benefits that are being taken into account, this graph is not helpful to you. So this graph is really only for a single individual who has not been married for more than 10 years. So we have no spousal benefits in play and we have no survivor benefits in play. So for an individual, really it just boils down to when are you going to take that benefit? And you have different options. We could take it as early as 62. We could take it at your full retirement age. So for this individual, I'm just using 66 to keep the numbers easy. And then we could wait all the way to 70, right? So that's kind of our three main data points there that we're looking at with this graph. And so really what you can look at is we want to say, if I took it at age 62 and I could collect $1,500 a month, that's the equivalent of $18,000 a year. So if I can do that for 4 years from 62 to 66, that means I'm collecting $72,000 from Social Security, okay, from 62 to 66. So another way to put that is that if I wait until 66 to collect my benefit, I've left $72,000 on the table. So the question is, how long does it take me to make that $72,000 back from the extra money that I receive each month because I waited? So for this individual, if you waited until 66, you would collect $2,000 a month instead of $1,500, which is an extra $6,000 a year that you're collecting by waiting. So if you had left $72,000 on the table in those first 4 years, in order to get an extra $6,000 per year, that means we take 72 divided by 6, which is 12 years. So that means that if you wait until 66 to take your benefit and you're a single individual, you really need to live past 78 in order for you to come out ahead in that decision. Okay. Now, the other one we can look at is age 70. So if I wanted to wait until age 70, how long would I have to live to, get the benefit out of that, the maximum benefit out of that? And the answer is you'd have to get past 82. So you'd have to live past 82 in order for those graphs to cross, right? That's where the purple and the gray cross there. So there are a couple, I always have I'm a previous engineer, so I'm all about the numbers, and I always have the engineer or the actuary that's on the call, and they'll point out the fact that, well, you could also look at what happens if you invested that money in the meantime. So if you took it early and invested and you got a rate of return on that, or, looking at time value of money. So, it's not a full picture, but it at least gives us a starting point in terms of what age do you have to live to in order to, make these various strategies worth it if you're an individual. And so with that in mind, we're going to look at both married, divorced, and survivor benefits. But before I get there, there's one other thing I want to point out with this graph, not just for individuals, but this applies to everybody. Anytime you try and collect Social Security benefits prior to full retirement age, so in this case, if I wanted to take it at 62, I have to deal with a earnings limit that Social Security has, or really the IRS has put on Social Security benefits. And so what I mean by that is in 2020, I'm going to pull up the exact number here. If an individual is making more than $18,240 of earned income, their Social Security benefit begins to be reduced. For every $2 over that 18,000 cap, they lose $1 of Social Security benefits for the year. So that is applicable anytime you are filing early. Once you get to full retirement age, you don't have to worry about the earnings limits anymore. Those go away. So I have plenty of clients that take their Social Security benefits starting at full retirement age, and they keep working full time because they enjoy what they're doing. They go down to part-time maybe, and they keep making an earned income. And so they can collect both. It doesn't affect them. But for an individual who tries to take it at 62 or 64, and they're still working full time, they're likely going to run into some issues with that reduction of Social Security benefits. And that earnings limit applies for individuals, for spousal benefits, for ex-spousal benefits, for survivor benefits. All of the benefits we're going to talk about coming up here have to follow that earnings limit prior to full retirement age. So please keep that in mind when you're looking at a graph like this and you're thinking about when you're going to be filing. All right. Let's see. Do we have any questions come through? It doesn't look like it. Okay. So I'll keep going. So for married couples, we really have a couple of different options these days. We used to have file and suspend, which was a very popular option, and that was eliminated almost 5 years ago now. And then we also have restricted spousal benefits that are still on the table. They're still available, but they are very limited at this point to only individuals who were born prior to January 1st, 1954, or on that day. Okay, so if you were born on January 1st, 1954 or prior to that date, you can still use the last option that's there, and we will talk about that. But for most of you on the webinar tonight, you can no longer use restricted spousal benefits either. So then it just boils down to filing for your own benefits or filing for spousal benefits. Okay, so let's dive into these, and we're going to use a case study of Tom and Mary, who are married. And so Tom is 66, Mary is 63. Tom made much more during his career, and or Mary didn't work a full 35 years during her career. And that's why you see the gap in their benefit amounts. So Tom's benefit amount is $2,500 when he hits full retirement age, whereas Mary's is $1,200 when she gets the full retirement age. And keep in mind that these strategies, when I'm talking about them, they work either way. It doesn't matter which spouse is the higher earner or which one is older or younger. As long as you follow the rules that we're going to talk about coming up here, you'll see how these work. So, all right, going back to our case study here. So Tom is 66. He takes his benefit, collects $2,500. 3 years later, Mary gets to her full retirement age of 66, and she takes her $1,200, which is off of her own benefits, off of her own earnings. So again, her $1,200 is based off of those 35 years of earnings. Now, what happens is because Tom has already filed, Mary is actually eligible for a spousal benefit, and it's either a spousal benefit or her own benefit. Okay, so it's one or the other, not both. So what would happen is that Social Security automatically looks, when she files, they automatically look at her benefit of $1,200 and compare it to the spousal benefit, which is 50% of Tom's. So that's $1,250 in this case. So Social Security will actually give Mary $1,250 per month, and Tom will continue to collect his $2,500 a month, making between the two of them, you now have $3,750 is their total benefit amount that they're collecting. Okay. Now, here are the important things that we have to keep in mind with spousal benefits, because we need to understand why Mary was eligible to take a spousal benefit. So both spouses have to be at least 62 or older to qualify for spousal benefits. They have to have been married for at least 1 year. So no shotgun weddings in Vegas, or these days with COVID, it would be at the courthouse. And then filing for spousal benefits the next day. You have to put up with them for at least 12 months, and then you get to go file for your spousal benefits. The last two bullet points are your spouse must first file for Social Security benefits first, or I guess I just said that 2 times, but they have to file first. And then the last one is, if claimed at your full retirement age, you will get half of their full retirement age amount. So I know that's a little confusing, so let's walk through it together with those various rules. So we're going to cover the third and fourth bullet point are the most important. So to start with, the reason Mary was able to take spousal benefits is because Tom had already filed. If we were having Tom wait until 70 to file for his Social Security spousal benefits, then Mary would not be eligible for a spousal benefit when she files at 66, because Tom hasn't filed yet. So in that case, Mary would get $1,200 for her benefit, because she still is owed her own benefit off of her earnings. And then when Tom files a year later, his benefit will have grown from $2,500 to $3,300 because of the 8% a year that he was getting for waiting. And when he files for his $3,300 a year at age 70, Mary will now be eligible to get the extra bump for the spousal benefits. Now, Mary will only get a $50 bump. She'll go from $1,200 up to the $1,250, which is half of Tom's original full retirement age benefit amount. Mary's spousal benefit does not go up because Tom waited until 70. Okay, so she does not get half of the $3,300 because he waited. That only helps Tom's benefit. It does not help the spousal benefit. Okay, so keep that in mind. So again, if he waits till 70, she'll get $1,200 for the first year that she files at 66. And then a year later, once Tom has actually filed, she'll get $1,250 because he's now filed. So she gets the extra $50 that's due for spousal benefits. Now, there's 2 other things we need to pay attention to here. What happens if Tom files early? So instead of it being $2,500 a month, he's going to take it at 62, let's say. And so he's going to receive $1,700 a month because of the reduction. As long as Mary waits until her full retirement age to file for a spousal benefit, she'll still get the $1,250 that she was due, which is half of Tom's full retirement age benefit, even though Tom took it early. So hopefully you're following me on that. If not, shoot a question in the chat and I'll re-explain it. But again, as long as Mary waits until her full retirement age to get the spousal benefit, she will get the full half of his FRA amount. Okay. So I hope that kind of, summarizes everything there for you. The other thing that I will say that's important to cover on this screen is what happens if Mary files early. Okay, so let's say that Tom files at 66 and he collects 2,500 and Mary files at the same time at 63. So instead of getting 1,200, her benefit will be reduced from 1,200 down to 900. I'm just making these numbers up. So I'm saying it's 900 is her benefit amount that she could collect because it's reduced. She's collecting early. Or she is eligible for a spousal benefit, okay, which is typically half of FRA, half of Tom's benefit, so $1,250. But the $1,250 is also reduced because she's taking it early. So the $1,250 will be reduced down to $975, let's call it, right? And so she'll collect $975 as her spousal benefit, and that is then locked in at $975 for the rest of her life. It does not go back up once she gets to full retirement age. So when you take those benefits early, it will lock in those reduced amounts and it locks in both yours and the spousal benefit and then just gives you whichever is higher. So hopefully that all made sense. I'm going to look at the chat because I saw one question it looks like came in. Okay, so does the spouse get the spousal benefit automatically when Tom retires at 70, or does the spouse have to file something? So as long as they are still married, so as long as we're not talking divorced benefits here, we're talking a married couple, when Tom files at 70, if Mary has already filed for her benefit, which in this case she has, so she was collecting the $1,200, that extra $50 for the spousal benefit will happen automatically. However, if Mary had not filed yet at all, then they don't just go ahead and file Mary for spousal benefits once Tom has filed. Okay, so as long as Mary is already in the books and is collecting a benefit, when Tom files, she'll get the extra bump for spousal. If she has not filed and she wants spousal benefits, then she has to go in and collect those and file for the spousal benefits. So hopefully that helps answer the question. I'm going to keep going. And then if you have additional questions on any of that I just covered, feel free to shoot those over. We've already covered that. So the $3,750 between the two of them was the original case study that we're looking at there. Okay, so let's talk about restricted application for spousal benefits. So I used to spend 15 minutes on this section and get a whole bunch of questions because it was pretty complicated. But because this doesn't apply to most of the individuals that are on the webinars anymore, I fly through this pretty quick. So feel free to stop me with a question if this still applies to you and you want to use the strategy and you don't understand. But I am going to fly through it pretty quickly here. So what we have is we have Mary receiving a restricted spousal benefit. So what that means is we're going to have Tom do the exact same thing that he did in our first case study, where he takes $2,500 at 66. Then when Mary gets to 66, her full retirement age, she collects only the spousal benefit. She does not file for her own benefit yet. So what that looks like is she files a restricted spousal benefit application. That's what it's called. When she does that, she is able to collect the $1,250 per month from 66 until 70. And then at 70, she can actually switch over from her spousal benefit of $1,250 per month over to her benefit. So remember that her benefit was supposed to be $1,200, but if she's waiting until 70, which in this case she is on her benefit, it's growing at 8% a year while she takes the spousal benefit of $1,250 at the same time. So she gets the best of both worlds, right? She collects the $1,250 per month for those 4 years. When she gets to 70, she turns off the spousal benefit, and now her benefit has grown from that $1,200 to $1,584. Okay. Now I had a question come in, so I will stop there. Okay, so Lucy had a question. I worked for federal government, did not contribute to Social Security. Am I eligible to claim benefits on my spouse who has contributed into Social Security? The answer is most likely no. as a short answer, but I will explain that a little bit more in a few slides from now. I'm going to get to, when you have a pension that you were not paying into Social Security. So definitely look out for that. It's in the next few slides. So on the ex-spousal piece, we've got a couple of items here that we want to cover. And so for the ex-spousal, it's very similar to married couple benefits, except there's a couple of rules as to how you have to qualify for ex-spousal benefits. So for ex-spousal benefits, you have to have been married for at least 10 years to your previous spouse. You have to be 62 or older, just like you do with any of the other retirement benefits. And your ex-spouse has to be age 62 or older. We're going to come back to that one because that's the most important piece. And then you have to be unmarried when you file for Social Security spousal benefits. The reason is if you are currently married, then your Social Security benefits will be based off of your current marriage, not off of your ex-spouse's record. So it doesn't matter whether your ex-spouse is remarried. That's a moot point in regards to Social Security. They don't care, right? All they care about is whether you are remarried or not. So let's go back to that middle one. So with spousal benefits, when you're married to an individual, we talked about the fact that your spouse has to have filed in order for you to get benefits off of their record. So in order for you to get the spousal benefits, your spouse has to have filed already. You can understand why that would create a major issue for ex-spouses, right? Most ex-spouses are not communicating with each other. And if they are, they're normally not talking about finances with each other. So you are not going to know when your ex-spouse has filed for their Social Security benefit. There is no, tag in the system where they reach out to you and let you know that your ex-spouse has filed for benefits. What they did to, eliminate all of that hassle is that they said, as long as both people are above 62, then we will act as if they have filed, whether they have or not. So what that means is for ex-spousal benefits, once you get to 62, and your ex-spouse is 62 or older, you can now file for your ex-spousal benefits whenever you choose to do so. If you file early, again, it's going to be reduced. You don't want to wait past full retirement age for ex-spousal benefits because they do not grow at 8% a year like your benefit would. So that doesn't make sense. So the latest you would wait for ex-spousal benefits is full retirement age. Okay. And the earliest you can take it is 62. All right, so that's ex-spousal benefits. So feel free to shoot questions over if you have any there. Survivor benefits is kind of a different animal, so to speak, because survivor benefits actually allow you to take the survivor benefit as early as age 60, whereas all of the other benefits in Social Security retirement benefits is age 62. So that's one key aspect that we have to be aware of. But really, there's two main items that we have to understand about survivor benefits. The first is, what is your full survivor benefit that you will receive at your full retirement age? And then when do you want to take that survivor benefit? So do you want to take it at 60? Do you want to wait until full retirement age, or do you want to wait until 70? So let's talk about the first piece of it. How do we calculate the full survivor benefit? So for the full survivor benefit, what we have is we have three different scenarios that could occur. Your spouse has already filed for Social Security. This is scenario one. They've already filed for Social Security and they die. When that happens, your full survivor benefit is whatever monthly amount they were collecting when they died. Okay, so that's a pretty simple one in terms of calculating what that benefit is. The second scenario is that your spouse was waiting until 70 to collect their benefit, but they died in between full retirement age and age 70. So let's say they died at 68. In that case, you as the survivor will get benefit for the fact that they waited from 66 to 68 in this case, and you will get an extra 16% increase on their full retirement age benefit as your survivor benefit, okay? The third scenario is that your spouse died prior to full retirement age and prior to filing for Social Security. In that case, your survivor benefit will be very close to what is shown on their Social Security benefit statement as the spousal survivor benefit. And so you'll want to look at that in the year that they died. And so what you would do is you would pull that up. If it's been mailed, you have a copy laying around, or you look it up on theirs, and you pull that up, and then you've got the information there in terms of what the full survivor benefit is. It's listed on the statement. It'll be close. It's still an estimate, but it'll be close in terms of what you actually receive. Once we know what that number is, so which of those three scenarios you fall into, we now know what the full survivor benefit is. So let's call it $2,000 a month. Now the question becomes, when do I take that as the survivor? So let's say I'm 58 as a survivor, my spouse has died, and my survivor benefit is $2,000 a month if I wait until full retirement age. That means if I choose to take it at 60, it's not going to be $2,000 a month. It might be $1,400 a month because of the reduction, because I'm taking it early. On top of that, I have to make sure that I'm not earning more than $18,200 because that's the earnings limit for Social Security if I'm taking it early. So for most survivors, they don't end up taking a survivor benefit until they get to full retirement age and don't have to worry about the earnings limits anymore. Or if they retire early, let's say they retire at 62 or retire at 64, then they could take the survivor benefit at that point and not be affected by the earnings limits. The one last piece, which is the bullet point at the bottom there that I like to cover, is that they do allow you, if you chose to, you could take your survivor benefit, let's call it at 60, and then you could actually wait and switch over to your own benefit at age 70 if you wanted to. So for instance, if I take my $2,000 a month, it's now reduced to $1,400 a month as a survivor benefit at age 60. And I want to keep collecting $1,400 a month until I get to age 70. And now if I want to, I can switch over to my own benefit amount from the earnings that I paid into Social Security. And maybe that's grown to $3,000 a month because I waited until 70. So now I turn off my survivor benefit and I turn on my benefit, right? It's one or the other. You don't get your benefit and a survivor benefit on top of that. Okay. Hopefully that makes sense there. I don't see any questions. So again, feel free to send your questions over as you had them. All right, let's talk public pensions. So this goes back to the question that we had about the government pension. So when you have a government pension or you are part of the teacher retirement system where you are not paying into Social Security while you're with in the pension, then what you end up dealing with is what's called the windfall elimination provision and the government pension offset. So the windfall elimination provision, also known as WEP, W-E-P, or GPO for government pension offset, is how you may see it written when you look at the different articles. So WEP applies to your benefit, your Social Security benefits, if you worked. So for instance, an individual might have worked 10 years in the private sector, they paid into Social Security, they got their 40 work credits, so they are eligible for a Social Security retirement benefit. But then after the 10 years, they started working for the government and they worked for the government the rest of their career. So on their benefit statement, Social Security is showing that they're going to receive $1,000 per month, right? Based on their 10 years of earnings for retirement. But what happens is because of the government pension, they actually use that WEP formula, the windfall elimination provision formula, to reduce how much you are going to get from Social Security. The maximum reduction for an individual in 2020 is $470.50 per month. And so if it was supposed to be $1,000 per month, you're now only going to receive $530 per month if your government pension is high enough to reach that maximum reduction amount. Okay. And there's more information on SSA.gov in terms of there's like tables where you can look at what your benefit amount is from Social Security, how many years of substantial earnings you had in Social Security, and what your government pension is. And you can look up at the table to see what the reduction is going to be. Now for government pension offset, this is what affects your spousal and survivor benefits from Social Security. So what they do is they take the amount of your government pension or your TRS pension, and they multiply that by 2/3, so by 0.67%, and that gives them a number. So let's say that your pension is $5,000 a month, right? And now they're going to take 2/3 of that. So let's call it $3,300 a month is what they're going to reduce your spousal and survivor benefits by, which in most cases, in almost all cases that I've seen, brings it all the way down to zero, and you get no spousal or survivor benefits from Social Security because of that government pension. Now, where you may still get a benefit for spousal or survivor benefits is if that government pension or TRS pension is small enough where the 2/3 reduction doesn't bring it all the way down to zero. So that's the case where you may get now it looks like we've got a question that came through. Okay. If you take your Social Security benefit at age 62, can you repay the total benefits collected and collect the higher benefit at full retirement age. Okay, so I think I understand your question. And I'm pretty sure, yes, actually, that was a perfect lead in to this slide here. So there's two miscellaneous provisions that I talk about with Social Security, and one of them covers that question that just came in. So this one, retroactive benefits, is not applicable to that. So I'll get to it on the next slide. I'll answer your question. But with retroactive benefits, here's where this comes into play. Is retroactive benefits allow you to backdate an application for Social Security benefits. Now, why would you do that? You can do that for up to 6 months. Well, if you're sitting on this webinar and you realize, based on something that I've said, that you should have filed already, let's call it a year ago, you can go into Social Security or call them and have them backdate your application up to 6 months ago. They will then give you a lump sum check for the amount that you would have received for those 6 months, and they will start your monthly benefit then moving forward. Okay. So that is an option for you if you found yourself in a position where you realize that you should have already filed. Now, the other one, which I call the oops provision, which covers this question that was asked, is there is a stipulation in the Social Security rules that will allow you up to 12 months. It is a 12-month window from the time you file to pay back all of the benefits that were provided to you, and they will act as if you have not filed when you do that. So again, another way to put that is you filed, let's say 6 months ago. Now you're on the webinar realizing you shouldn't have because of whatever the various strategies are that you're looking at, and you choose, oh, I shouldn't have filed. I'm going to take that back, right? So you write them a check for the lump sum, the gross amount that they had paid you. There's no interest or penalties due. You give them that check, and they will act as if you had never filed. Now, you can only do that once in your lifetime. And again, it's a 12-month window. It used to be unlimited. So then what you ended up having was people would go in at 62, they would file for benefits, they would take their benefits for 8 years until 70, they would invest those benefits in the meantime, hopefully get growth out of it, and then at 70, they would pay back all of the Social Security benefits that were paid to them, and they were able to keep the growth that they had received from the investments, and they act as if they had never filed. Obviously, the IRS, figured that out pretty quickly with that loophole, and they shut it down. So if you had seen some articles about being able to do that, it is now a 12-month window and has been for a little while now. Let me go to the chat. Looks like we had another question come in. So Sharon, hopefully that answered your question on that piece. Barb, you had asked, I was in IMRF for 15 years and TRS for 5 years. Are the two programs viewed differently for Social Security? And the answer is yes, they are. So IMRF, when you were with IMRF, you were paying Social Security taxes on your income. Because of that, your IMRF pension does not offset anything with Social Security. It does not affect your Social Security benefits at all. So you can collect your full IMRF pension and your full Social Security benefits if you had just worked for IMRF. Because you also have the TRS pension for 5 years, I don't remember. I think 5 years is kind of that mark where you're now vested for the pension. So if I'm correct on that, where you are now eligible for that pension with TRS, that pension will offset some of your Social Security benefits because of the TRS pension. So you will want to be careful about that and do some work to calculate that. And I can help with that. Your planner, if you have one already, can help with that. Run the numbers in terms of how much of a reduction you would expect from that piece. But it is important to understand that they are treated differently. IMRF is more favorable because you were paying in to Social Security. TRS, you were not paying into Social Security. So then you've got to deal with those offsets. All right. So we're going to move on. We've got a few remaining items here. So cost of living adjustment. This is a quick one. Again, my little screen here is in the way, so I can't see it. There we go. So 2020 cost of living adjustment was 1.6%. In 2019, it was 2.8. That is all based on an inflation index that they use, that Social Security uses to calculate. And that does not include medical expense inflation in retirement. They've stripped that out of the index that they use. And so with that, one of the things you have to be aware of is that I believe in 2021, they did come out with the latest cost of living adjustment. If I remember, it's either 1.2 or 1.3, if I'm remembering correctly. on that piece. So for next year, for 2021 is what I'm talking about. So they apply that automatically. You don't have to do anything to add that to your benefit. You get a letter every October or November telling you what the new cost of living adjustment is for the upcoming year and what your new benefit amount is going to be. So that is applied automatically for you. Okay. So two main items that are left. It is the earnings limits, which we've talked about already. So I'm going to cover that in a little bit more detail here, just so you make sure that we're on the same page. And then we're going to talk about taxation of Social Security benefits. And then I'll give you a quick planning opportunity potentially for Roth conversions and how to keep your Social Security benefits from being taxed. So, all right. So we're going to start with the earnings limits for Social Security. So for the earnings limits, I've already talked about the 18,240 limit. Keep in mind, these are earnings limits. This does not include pension income, IRA withdrawals, 401k withdrawals. It doesn't include income where it's like interest income, dividend income, capital gains income. None of that is included as earned income towards that 18,240 limit. So if you are no longer working, but you have investment income coming in, or you're pulling money from your IRAs, you don't have to worry about those earnings limits. Okay. So basically, any calendar year prior to the year that you're going to turn full retirement age, you have to deal with that 18,240 earnings limit if you're trying to collect Social Security benefits early. Okay. And what they do, I'd mentioned this before, is that for every $2 over the cap, they reduce your Social Security benefit by $1. So if I do a case study and I say, let's say that I'm making $40,000 a year and that the cap is 18,000, just to make the numbers easy, that means I'm 22,000 over the cap for 2020. And so they're going to reduce my Social Security benefits by 11,000, by half of the amount that I was over the cap. So if they're going to take 11,000 off of my Social Security benefits this year, and it was supposed to be 2,000 a month is what I was supposed to be collecting, that means that I'm going to not get a benefit in January, February, March, April, May, and half of June, right? They get their 11,000 first, and then they start paying out my full benefit for the rest of the year. And then once it hits January of the following year, it starts all over again and they get theirs first, and then they start paying out mine. So for most individuals, if you are significantly over that cap, you're not going to file for Social Security benefits prior to full retirement age. So just keep that in mind, that it's not really meant to be a supplement to your earned income unless you're staying under that $18,000 limit. Okay, once you get to full retirement age, the month that you are hitting full retirement age, you can make as much money as you want to, and you don't have to worry about a Social Security reduction. You do have to worry about taxes, and we'll talk about that next. And then in the middle column there, that is the calendar year you are turning full retirement age. So if you're turning full retirement age, let's say in October of this year, then you would have the first 9 months that you would have to stay under the earnings limit. And so from January to September, you would have to stay under the prorated amount. So 9 out of 12. So if we take 3/4 of that 48,000 number, that's 36,000. So I need to earn less than 36,000 between January and September in order to stay under that last calendar year limit. So just keep that in mind when you're doing earnings and you're looking at filing early. You've got to be aware of this and how that affects you. All right, I don't think we have any other questions come through. Okay, so let's talk about taxation of Social Security. So there's a couple of things that I want to address here. Number one is state taxes. So in the state of Illinois, Social Security benefits are not currently taxable. Neither are any other retirement income. So pensions, IRA withdrawals, annuities, any of that income from IRAs, none of that is taxable, okay, for state. Now, I had mentioned annuities. That's if it's in an IRA. If it's outside of an IRA, then annuities would be taxable, but that's another subject. So just want to make sure that was clear. But with state tax, Social Security benefits are not taxed, okay? Now, that is for Illinois. There are states, so I believe there's 13 at the moment, that do tax Social Security benefits in some way or another, meaning they all have different ways that they tax it, but they do tax it. Okay, so some of the states provide, they say for the first 10,000 of Social Security income, it's not taxable, but everything above that is at whatever the state income tax bracket is. Others have a tiered system, as to how they tax it. And so you do want to make sure that you are paying attention to that if you are planning on moving to another state. One of my blog articles actually from like 6 months ago, if you want to look up my website and you can look at the blog article, I'll have that at the end of the presentation here, does address the state taxation, and it gives you the list of the different states. If you're welcome to take a look at that if that is applicable to you if you're moving. So for federal taxes, that's what I'm talking about here. Since state taxes for Illinois are not applicable, federal taxes are applicable. So for federal taxation of Social Security benefits, we have to calculate what your provisional income is for the year. Now, provisional income is a term that is used by the IRS for Social Security benefits specifically. And the way it's calculated is that they take your adjusted gross income off of your tax return. They add back in municipal bond interest, which is what's non-taxable interest. That's what that means. Plus, they add in half of your household Social Security benefit as well. Once we have that number, let's call it $50,000 for a married couple, okay, household that's coming in. We then compare it to this chart that's here, okay? And so this chart, what it's showing us is we have to figure out, are we single, head of household, married filing separately, or are we married filing jointly? So I had used the case of married filing jointly, and I said that our provisional income is $50,000. Because I'm above the rightmost column there where it says above 44,000, my Social Security benefits will be fully taxable, okay, up to the maximum extent. And so here's what this means. I know it says up to 85% is in the column. So I'm going to walk you through it. If my benefit, my Social Security benefit is supposed to be $2,000 a month, they give me a little bit of a discount, a little bit of a break on the first 15% because they're assuming that's what's being used for Medicare premiums, okay? Another way of putting it, I've also seen it put, is that they're also assuming that's a portion of your contributions where you paid in to the Social Security system, so they don't want to tax you on that again, okay? So those two items, they take 15% off. So if I'm supposed to be at 2,000, 1,700 is 85% of 2,000. So $1,700 per month is now added to my tax return as taxable income for federal taxes. So then that $1,700 I pay tax on based on whatever my federal tax bracket is for that year. So if I'm in the 22% tax bracket for federal, for married filing jointly, then on $1,700, I'm going to pay roughly $360 in federal taxes per month on my $2,000 a month Social Security benefit. Meaning that instead of getting $2,000 a month, I'm actually only going to get $1,640 a month. So you need to be very careful about understanding how your benefits will be taxed so that you're not planning cash flow around the gross amount if in fact you're only going to be receiving the amount after taxes and it is truly going to be taxed. Now, for individuals that fall under the leftmost column where your provisional income comes in under those numbers, you will pay no federal tax on your Social Security benefits. And if you're in between, then it's prorated, okay? So let me take you through the example that I have for you of just some opportunity that may be available to you depending on what your situation looks like. This is something you definitely want to talk about with a financial planner, whether you have one or you want to sit down and talk through it, and with your accountant as well. Both of them need to be involved with these decisions because you need some tax projections run for you. And so what we are looking at here is we're looking at two couples that both have the exact same total income of $67,000. Okay, so they have the same living expenses, same income that they need. The only difference is that couple one is taking $25,000 out of their IRAs every year to get to that $67,000, and couple two is taking it out of their Roth IRAs every year to get to the $67,000 and not taking anything out of the IRA. As you may know, once you get to a certain age, that's no longer an option. So once you get to age 72, you have to take out RMDs from your IRAs. So in this situation, in this scenario, we're looking at couples that are under that age 72 mark, okay? So in a lot of cases where we would find this is, let's say you retire at full retirement age at 66 or 67, and then you don't have to take money out of your IRAs until age 72. We may have 4 or 5 years there where we could get your Social Security benefits completely tax-free for federal tax, okay? And the way we would do that is by using Roth IRA withdrawals or using brokerage account withdrawals and trying to match up our losses and gains so that we don't have a taxable consequence there. and stay under these previous limits of 32,000 if you're married filing jointly, or 25,000 for single head of household. Now, for some of you who have pensions or you have significant, you have other earned income or anything else coming in the door, you're probably not going to be able to use this strategy. Okay, this is really for those individuals who don't have any earned income coming in. They're taking their Social Security benefits, and then they need some additional income to live off of. And we're trying to figure out where can we pull that from to live off of. Okay, and so in this case, couple one and couple two both have the same income. The only difference between the IRA and the Roth IRA, when we do the provisional income calculation, IRAs are included, Roth IRAs are not. So couple one's provisional income is 56,000. Couple two's provisional income is 31,000. And when we go back to these charts, you'll see that the 56,000 for couple one is above that 44,000 number. So their benefit is going to be taxable. Whereas couple two is at 31,000, which is below the all Social Security income is tax-free level. And so in that case, they will pay no federal taxes on their Social Security benefits, even though they both have the exact same total income. Okay. So one of the issues with being able to use this is that if you don't have substantial money built up in a Roth IRA, the only way to get that is to make contributions if you're still working, or to do Roth conversions. And that's where the accountant and the planner come in as to looking at whether that makes sense for you or not, based on how much you could save on Social Security federal taxation. So hopefully that's helpful to you and just throws out an idea for you to take back. All right, so how do I help as a planner? So I've got some free Social Security resources you're welcome to check out at thedalagroup.com. And so those are just some free flowcharts and things that you can use to see if you qualify for the various benefits. And then I also have a program that I run for anyone who wants to come in and go through their Social Security benefits. And so I'll use the Social Security analysis software to run your various benefits. So, let's say you're married, you come in, you bring in your benefit statements and you say, and again, this can be done virtual with everything going on right now in our world. And so, we do this and you say, okay, Mike, like what happens if I wait until 70 and my spouse takes it at 66? What if I take it at 66 and she takes it at 62? What if we flip that? Right? And we can run these scenarios in 15, 20 minutes really quickly and line them all up next to each other and figure out what actually makes sense for you based on what else you have going on. So we've got to put this in context with your other pension dollars, your IRA dollars. How does all that fit together from a retirement planning, Social Security analysis standpoint? And so for that analysis, I don't charge anything for, the people who have attended this webinar. If you want a second opinion on your current retirement plans, your investment portfolio, anything that you're doing right now with another planner, I would love to do that for you along with the Social Security analysis. If not, that's okay too. I do a lot of work for individuals who already have planners. They're comfortable with that person. They're not looking for, a second opinion on anything. I'm happy to do the work for you for 15, 20 minutes over the phone, answer your questions about Social Security. I'm perfectly okay with that. So if that's something that you want to do, whether you want the second opinion or not, and you want the analysis done, feel free to go ahead and send your contact information over. You would just email that to me. So my email is right there on the top. It's mheatwole@thedalagroup.com, or you're also welcome to call me at the 847 number that's listed there. And then again, feel free to check out thedalagroup.com, which is just my free resources that are on there, as well as my blogs as well, if that would be helpful to you, and you can sign up there for that as well. So I don't think we have any final questions. Let me look at the chat box to see if there's anything else down there. I don't believe so. Okay. Nope, we're good there. Okay, so Barb, do you have any final thoughts or anything you wanted to say before we sign off here?
Nope, I think I'm all good. I'd like to thank you for your presentation, very informative, and to thank everyone who came tonight. Okay. So have a good evening, everyone. Have a good evening, Mike, and that's it.
All right, thank you, Barb. We'll talk to you soon.
Sure, bye-bye.
Bye.